Over the last 100 years, the S&P 500 has been on an absolute tear in the stock market by providing investors of all ages high returns on average of 10% per year, coupled with solid dividend growth for passive income that is better than having your money sitting in a bank savings account, all while being a relatively stable investment that is simple, easy, and effective to become a multi-millionaire in the long run, since you have 500 of the best performing companies in the entire world, so you can sleep at night knowing that your money is safe and sound. Now, with all these great benefits of the S&P 500, specifically one ETF, that being Vanguard's VOO, the big question is, well, how much should I allocate or even invest in the S&P 500 or VOO to achieve the best retirement and even the highest returns in the long run? Well, in this video, I'm going to be breaking down exactly how much of the S&P 500 you should be buying through my ultimate guide for the highest returns, using VOO as our example for simplicity purposes, that you should be buying based off your age, your time horizon, as well as your risk tolerance, so you can have the highest returns in the long run, retire with more money by the end of your investing journey, and thanking me later by liking this video and subscribing to our channel, because you have the right amount of the S&P 500 and or VOO in your ETF or stock portfolio. Now, this allocation strategy that I've developed works for pretty much any S&P 500 index fund like VOO, SPLG, IVV, FXAIX, etc., and even a total stock market index fund like Vanguard's VTI, so keep that in mind. Now, before we get started, I am not a financial advisor. This is not financial advice. This is just my opinion of what I believe is the best guide for the highest returns in the S&P 500. Now, with all that out of the way, I have 3 age categories and 3 assumptions. The first is that you're age 18 to 35 years old. The second is you're age 36 to 50 years old. And the third group of investors is age 51 to 65 plus into your retirement. With the first category of young investors starting off investing in the S&P 500 or Vanguard's VOO is probably the best way to invest forever, because you can write out compound interest, which will skyrocket your portfolio in returns, and you can have the confidence because whenever there's a recession, unlike a stock that never returns to its previous highs, the S&P 500 has broken all-time highs and has always bounced back every single time. At this age, you should have a higher risk tolerance because you have a bunch of time until the age of retirement of age 65 and up, or even as early as your 50s because you started investing very early compared to those in the other 2 age categories. The portfolio composition I would say is optimal at this age range is to have VOO from 35 to 100% of your stock portfolio. So for every $100 you have to invest into VOO, you can invest anywhere from $35 to $100 of that $100 initial investment. Now, the reason why you can do up to 100% of the S&P 500 in your stock portfolio is because the S&P 500 is legit one of the best investments to make. From portfolio managers, famous investors, or maybe even your grandparents might have said that the S&P 500 is legit as it comes for growing your wealth. You could also have 500 of the best stocks in the world, so if Nvidia is going up over 250% over the past year, don't sweat it because Nvidia is in the S&P 500, and even Microsoft, and even Apple, or even Tinder, so you will never miss out on any investment with the S&P 500 or Vanguard's VOO. Now, the reason why you can have the lower end of this percentage scale is because you can invest what's left over into a growth ETF to achieve higher returns and even beat the S&P 500. Now, the best growth ETFs in my opinion are going to be something like SCHG, VGT, FTEC, XLK, VUG, QQQM, etc., and growth ETFs focus on investing in fast expanding and often more volatile companies like tech stocks in hopes of achieving above average returns. Now, this all sounds amazing in that growth ETFs can achieve higher returns, but remember, they are more risky. For example, let's say that the S&P 500 goes down something like 3% in any given day. You can expect growth ETFs to fall more than 3%, and these investments have low dividend yields and usually have higher expense ratios than the S&P 500 funds. I have a back tester that shows investing $100,000 into 2 portfolios over the past 10 years. One with 100% to VOO for something like 50% to VOO, and the other 50% to a growth ETF like VGT by Vanguard for simplicity's sake of a 50-50 split. The results of having both portfolios are super high with excellent returns, but having VOO at a 50% allocation wins as it achieves a higher return of over 16% on average annually, and ending with a final balance of over $460,000 from an initial investment of $100,000, and 100% to VOO is high as well in returns at around 12.5% on average annually, giving us an ending balance of over $325,000. $100,000. Another tip is to please don't ever invest into multiple S&P 500 index funds, because that's going to get you nowhere and you aren't diversifying at all, or even more than you already are, or even buying a total stock market index fund like Vanguard's VTI and combining it with VOO, because they're essentially like the same thing-ish. It's a lot to explain. Just don't invest into both of these funds or the same fund, because that's going to get you nowhere at all. The second category of investors, ages 36 to 50, at this age, your risk tolerance should inherently be lower than those in their 20s or even their early 30s. Now, you might have a mortgage, kids, and a family to take care of, so you really can't afford to lose a ton of money if the stock market drops, and you really have to wait for a recovery. With this medium risk tolerance, I would say to allocate no more than 50 to 100% of your stock portfolio into VOO. Investopedia says to have something like 60 to 70% into stocks like the S&P 500, but 50% is the lowest, as I know some people in this age range love their dividend stocks and even their growth stocks with a 3-fund portfolio, so you can have 50% to the S&P 500 and the other 50% into whatever investment you want or those investments. Now, some people might be thinking, well, why 100% still? Well, the S&P 500 is less risky and less volatile than a growth ETF, and with it paying a good dividend of around 1.5% on average and yielding stable returns, you still have anywhere from 15 to 25 years, depending on your preference, to retire, which is plenty of time to accumulate and even protect your wealth. If you have 60% into VOO and the other 40% split between a growth ETF like VGT and a dividend ETF like DGRO compared to 100% into VOO, the results of having 60% into VOO obviously wins, combined with great investments, as it achieves a higher return of around 13.9% annual returns and ending with a total balance of well over $300,000 from an initial $100,000 investment. 60% to VOO is pretty stable and moves like the S&P 500, but not exactly, since we do have growth and dividend stocks into the mix. Even 50% to VOO and 50% to growth, the same is true for this. Lastly, we have those near retirement of ages 51 and 65 plus, which hopefully all your kids are all grown up and all out of the house. You finally are at a chapter in your life where you get to live, to get to enjoy all your hard work by traveling, buying the car of your dreams, or even the house of your dreams, and doing whatever the heck you want on your own terms. You should have a lower risk tolerance because you should be preserving your wealth rather than accumulating it, unlike those in their 20s, 30s, or even their 40s. The recommended percentage to VOO I have in mind for this group is anywhere from 10 to 50% of your portfolio, and whatever you have left, you should allocate to a wealth portfolio that should provide more income generating investments, like something like real estate, a high yield savings account, a CD, or maybe even a dividend fund, just not all stocks. Now, 10 to 20% might seem low, but hopefully you invested for at least 15 plus years at a higher percentage rate allocation to take advantage of compound interest. But if you're maybe late to the game, then maybe 35 to 50% will do just fine to generate more wealth in your later years of your life than doing something like gambling or sports betting or even day trading. So you're going to be doing it in a reliable and safe manner. Now, if we have a retirement portfolio with 25% allocated to the S&P 500, a real estate fund like VNQ by Vanguard, dividends from SCHG, and 25% to a cash interest account with a $100,000 initial investment over 10 years, you still will achieve great returns of 8.28% on average annually and end with a total balance of nearly $225,000. Now, this will underperform the S&P 500, yet this will grow your wealth and provide a stream of passive income from these interest and dividend funding investments. If you guys want another tool on when to buy the S&P 500, you guys can check out Seeking Alpha, because they have many different rating tools by analysts and quant ratings on every day. They have a rating on when is it a good buy, a sell, or a hold to buy the S&P 500. As you can see for the past week, every day has been a buy rating, and lately the S&P 500 has been going up. So if you guys want to check out this tool by Seeking Alpha, link in the description down below. And that about wraps it up for this video, guys. If you guys enjoyed this video, please smash the like button because this cute puppy did, and comment down below how much VOO you have allocated to your own stock portfolio or the S&P 500, or maybe even what alternative S&P 500 ETF that you have, like SPLG, IVV, FXAX, etc., etc. I love you guys so much. Have a great rest